I'm just going to do the cloud. Okay. All right, we're recording, just so everybody knows. So I'll be on your best behavior here. Oh, I'm just kidding. So we are here with Multifamily Masters Live. This is our, let's see, our first one in June. We've been doing this since January. We've now upped our frequency of doing this to every 2 weeks. We have a number of guests on here. We have had syndicator panels. We've had lawyers. Today we're gonna have a special guest. Brandon Hall is our CPA that's going to be talking about some tax advantages of real estate and things like that. But before we kind of get into it, we'll get into a little bit of just kind of our quick bios and everything, and a little bit about Multifamily Masters. We are a global community, basically a networking community that's growing significantly fast. We've started with 1 chapter in Los Angeles, and now we're up to 70 chapters, I would say. A few we got 1 in Hong Kong, we got 1 in Dubai. We're potentially launching a couple others in internationally as well here soon as well. And we're all about growing and educating people, making sure that you know the steps of going through multifamily investing, and we're here to educate people and really network and build relationships and partnerships with people. So I myself am Powell Chi. I started the group about 2.5 years ago. And now I run the Manhattan Beach chapter with Chris Collins, who you'll see on here. And him and I run the Manhattan Beach one. And let's see, I've been doing multifamily investing since 2017. Started in Indianapolis with a 40 unit, went to a 61 unit, and now have about 1,000 units under my belt as general partner, and always looking to do more. So how about you, Ferris? You want to go ahead and kick off yourself as well?
All right, I'll go ahead. Hey, everyone, how's it going? Thank you, Powell. And just a heads up, our third partner, Garrison, couldn't make it as well. So he had some other things to kind of take care of. But as Powell said, we kind of help really shepherd, multifamily masters. And we have a strong team behind us as well, including the lovely Bethany. And I think the other 2 people aren't on as well. But, as Powell mentioned, it's an awesome community. We've definitely been growing it. And the idea is really adding value, right? Adding value to leaders, adding value to the rest of the community, and really providing an environment where people can learn and ask questions. And so for anyone that's out there, hopefully you watching this, you're getting value from this, you are enjoying things, and we're always looking for feedback and recommendations. So if anyone is has ideas, whether it's a speaker or a topic they'd like to, us to help coordinate, let us know. Right. In addition to that, too, I guess we do have a vast community and a vast network. So we're always happy to help connect people, happy to help, try to find speakers. If you ask us to go get, Bill Gates on here, we probably won't be able to pull that off, but just about everything else we can try. Yep. And so, I do have
Not yet. Next year.
That's true. That was probably in, Q3 2021. So we're figuring that one out. But, so I guess with that said, for me, my background, I'm based here in Houston, lovely Houston. I guess you guys can't see, it's pretty humid and hot outside. I have a company called Disrupt Equity along with my partner, Ben. And we have 1,500 units throughout basically Texas and Georgia. It's kind of our primary 2 hotbeds. And, we're vertically integrated, so we have our own management company and continuing to grow from there. And so I guess, with that said, let's go ahead and just maybe kick it off with our speaker, right? So I think for this one, we're going to let Brandon kind of introduce himself and kind of go through his presentation. And then at the end, we'll probably break it off. We like to basically, the thing that we've been trying to do lately, and it's been very successful, is doing these short breakouts at the end, right? So think 10, 15-minute breakout where we'll split this group up into, smaller groups of 5, 6, 7 people, right? Where you guys can get to kind of know each other and maybe get to know one of us, right? It's randomized, but the idea is, again, creating a little bit more of an intimate environment, right? And helping us, helping you and helping everyone get to know each other. And so look for that on the tail end of that. But with that said, without further ado, one of the topics we know a lot of people have a ton of questions on is around accounting and taxes, right? Real estate is a very, very powerful vehicle. And I wish I knew it even earlier on in my life, right? But it's a massive vehicle. Specifically, people get really confused with it, right? Because people think of real estate and think of appreciation. That's the thing that most people think about in the residential world, right? But they don't really realize the real value is in the depreciation, right? It's kind of almost, they're counterintuitive, but it's a very powerful topic. There's tons of, it's the kind of thing where if you know enough, you will make money tremendously in just maybe what you might learn from this lesson, this kind of session. So, without further ado, we wanted to make sure we got on, someone that's very competent, highly recommended to come and really present to the group and teach everyone, their expertise about it. And so with that said, Brandon, we'll go ahead and take it off.
Yeah, thank you very much for the intro. I really appreciate you guys having me on and appreciate the invite. So I'm Brandon. I run the Real Estate CPA. It's a CPA firm. I'm technically based in Raleigh, North Carolina, but it is a national CPA firm. I have a team of 15 employees, not including myself. So I guess a team of 16. And most of us invest in real estate ourselves. It's kind of our unique, I guess, competitive advantage in this space. I invest in multifamily assets. Another guy on my team just sold an 82-unit apartment building. Another guy on my team has 100 properties. Another one has 25. So we really walk the talk. We're doing the things that we're recommending to our clients. We're also implementing ourselves for the most part, which is really neat. I got started in 2015. I started the firm in 2015. Wasn't really enjoying my big corporate, Big Four accounting position, and wanted a different way out. And I didn't intend to start a CPA firm. I found real estate first and started investing in real estate, then realized it was going to take me a little bit longer to scale than I wanted to. I'm a pretty impatient person. So I launched the CPA firm in addition to that and went full time at the end of 2016, and the rest has been history. But we only service real estate investors. We have about 550 clients across the United States. Most of our clients are located in San Francisco, New York City, and we've got like a pocket in Atlanta, Georgia forming now, but we do have a client in every single state. And we are really good at the tax advice, the tax advisory piece, consulting. We do preparation and accounting as well. We work with really small clients, and then we also have really large private equity firms. I see somebody says, do we do internal audits? We do not do audits. I have always stayed very far away from audits because they come with all sorts of additional regulations, peer review requirements that cost 20 grand a pop. So I decided early on that I wasn't going to do something like that. So we do stay away from audits, but yeah, that's me. And I don't have a was I supposed to bring a presentation?
No. We'll definitely kick it off. And so
okay, cool.
maybe, with that said, right. So maybe another question. So for those listening, what is your core audience, right? In terms of, is it the person that has 1 to 2, 3, 4 houses and you're giving them tax advice on how to structure and kind of, maximize their tax benefits? Or is it the syndicator that has a 150 unit deal with, 20 investors and you're completing the CPA tax part of it and you're helping them, individually plan? Kind of who's your core bread and butter, right? And then for everyone else, also go ahead and start dumping in your questions and we'll start to kind of, really run them through. This is really meant to be an opportunity for people to ask things that might be more specific to them. So please don't hesitate to ask.
Yeah, so we actually have 2 separate groups at our firm. We have the groups that focus on the syndicates, the real estate funds, and the private equity funds. And then we have a group that doesn't. They focus on what I would consider a more mid-level landlord, 10 properties or so. We do have quite a few clients that have 2 properties, 3 properties. Our smallest client is a lady that has a condo that's a rental in Florida. That's her only real estate property. And if any of you guys have gone through our sales process, I'll be the first one that tells you, you don't need our services. We're going to be too expensive for the value that we're going to provide. And she was like, don't care. So our smallest client is a single family condo in Florida. But yeah, I would say we provide the most value to people that have about $1 million worth of real estate. Whether that's 1 property or 5 or 10, it doesn't really matter. We provide a lot more value to multifamily investors than we do single family, commercial assets, or anything like that. The reason for that is multifamily properties have a lot more flexibility under the 2013 tangible property regulations in how you treat expenditures. So an example that comes right out of the tax code that I love to share with people is if you have a 10-unit property and you have 10 HVAC units, all units under one roof, each unit has its own separate HVAC unit. If you go in and replace 2 HVAC units out of the 10, a lot of CPAs would say, oh, you just spent $10,000 replacing the 2 HVAC units. That's a big expense. So I'm going to put that on the balance sheet. I'm going to capitalize it and I'm going to depreciate it over 27 and a half years. But what we would do is we'd say, well, let's actually look at the 2013 tangible property regulations. Let's step through the betterment adaptation restoration test. And when we step through those, we realize replacing 2 out of 10 is not a material improvement to the HVAC unit of property, meaning that we can 100% expense it as a repair today, rather than recovering the cost over 27 and a half years. And the additional benefit to that, so we get all of our tax benefit today, but in addition to that, when I sell the property in 5 years, I don't have depreciation recapture because I never took depreciation on those HVAC units, right? And I took it all up front as a repair, just a current expenditure.
And that's the real one. That's the real value right there, that last bit. It's not that you're front loading it, it's that you don't have to do the recapture, because that's what, kind of from my experience, that's where the killer really becomes, right? You get to do this constant planning to avoid the recapture.
Yeah. And taking it up front is valuable. It's valuable because you get the time value of money, right? So your tax savings theoretically grow over time, but definitely at the end, there's no recapture. And the larger the multifamily properties, so now we're talking about syndicators, right? They're buying 300 unit properties. The larger you get, the more flexible it becomes. And so the materiality threshold is about like 30% or so. So it really gives you a lot of leg room. And our clients that do the best with us are the ones that allow us to help them kind of time their rehab schedule out.
Got it. And so it's not just in the tax planning and tax advice, but it's that coupled with actually completing the taxes and, adjusting the allocations accordingly is really kind of the focus for your firm, right?
Yeah. I mean, I would say that our bread and butter is the advisory piece. It's stepping through the complicated piece of the code that a lot of other CPAs are unaware of or don't necessarily know how to step through. But definitely doing the taxes on the back end. I mean, the advice is great, but if it doesn't actually get into the tax return, then it was pointless at the end of the day. So that's another big factor.
Got it. Awesome.
Hey, Brandon, how do you determine and how would you help real estate investors determine what would be able to be what you capitalize and what you would be able to put in expenses in the year?
Yeah. So the question is really, I have an expenditure. Can I write it off today as a repair, or do I need to capitalize it? And if I do capitalize it and I put it on the balance sheet, how long do I depreciate it? Is it 5, 7, 15 years, or is it 27 and a half years? And again, we just look at the 2013 tangible property regulations. So we step through that. We look at all the relevant court cases. Well, we don't do this every time, but we know all the relevant court cases. And we basically just know, okay, if you have a certain expenditure, then we can write it off either under one of the safe harbors with the 2013 tangible property regs. The de minimis safe harbor is a big one that everybody knows. Or if we can't qualify for a safe harbor, we look at the betterment adaptation restoration test, and that's where that materiality threshold really comes into play.
Awesome. And maybe, for those, I guess, on the call that maybe aren't as familiar, I want to just give a brief high-level overview of, what it means to depreciate, what it means to recapture, and kind of how that plays against people's incomes, right? And the different buckets of incomes between, ordinary income and capital gains, right?
Yeah.
Just so people on the call, I know we have a big spread of people, just so people probably that aren't as familiar, you can just get the foundation for probably what we're going to continue to talk on for the rest of this call.
Sure. So when you buy real estate, you depreciate the value of the building over 27 and a half years. And what it's supposed to do, it's supposed to track the deterioration of your asset over time. So they pick 27 and a half years. And depreciation is just an annual expense that I get to claim. I don't have to spend any more money for it every year to claim that expense. So oftentimes it's referred to as a phantom expense. It's a real expense, but you don't have to actually shell out cash every single year to claim it. And what it creates is this sort of parity where I can cash flow positive, but I can report to the IRS that I've actually lost money thanks to depreciation and things that we can do with depreciation. So that's depreciation. You buy $1 million asset, you allocate $800,000 to the building, $200,000 to land. You can't depreciate land. You just depreciate the $800K building improvement value, and you do that over 27 and a half years. And then we have cost seg studies, and a cost segregation study. The whole point of that is to say, well, in this $1 million building, not all the components are going to last 27 and a half years. Some components are only going to last 5 years. Some will only last 7. Some will only last 15. So a cost segregation study is the act of essentially reallocating that $800K building value to 5, 7, 15, and 27.5-year property. So we're kind of accounting for like the carpet that's in the units, the appliances that are already in the units, the paving in the parking lot, the shrubbery, those types of things.
Got it. And then you want to, maybe the other part of the second half of that question was just about how to take those losses and apply them to income to save money, right? Like, you know, and how that kind of, how that's structured, right? And what it can be applied towards and what it can't be.
Yeah, and this is where it gets deep. So actually, before I touch on that, I'm going to hit depreciation recapture. So depreciation is great, right? While it's benefiting you, but when you liquidate the property at some later point, you're going to have to pay a recapture tax on any depreciation that you have taken or could have taken. And that could have taken is really key, because every once in a while we'll get a new client that'll come on board. We'll review their tax returns. And we'll say, hey, you haven't been depreciating your property. We need to fix this. And they go, no. Don't worry about it. I don't want to pay that recapture tax at the end. And we're like, oh, well, you're not aware then that the IRS doesn't care. They're going to tax you even if you didn't take it on the depreciation that you could have taken. So you do have to pay a tax whenever you sell on the back end. So let's say I've got this $1 million property. I depreciate it $150,000 over the hold period, and then I sell it for $1.2 million. Now, at face value, you would say, oh, there's a $200,000 capital gain because I sold it for 1.2, I bought it for $200,000 spread. But in reality, my basis is $850,000. My adjusted basis is $850,000 because I claimed $150,000 of depreciation during the hold period. So in reality, I have that $200K capital gain, but I also have an additional $150,000 of what they call Section 1250 gain as well. And that's the gain that has to be recaptured, and it's typically going to be recaptured at a 25% tax rate. So I'll pay a 25% tax on the $150,000, and then I'll pay capital gain tax on the remaining $200K. And for people that invest in syndications, sometimes this can really shoot them in the foot, because especially if they can use the loss during the hold period, because they'll get to that end at like way down the line, they'll have pretty much zero basis in the syndication, and then they'll have a $150,000 capital gain, 50K of which is actually capital gain, and 100,000 which is Section 1250 recapture, and all of a sudden their tax bill's 40,000 and it wipes out their distribution. So it takes some kind of careful planning for that end goal. But for us, you mentioned the how do you claim the losses, and so this is where it gets complicated. Section 469 of the tax code defines rental real estate, and the default treatment of rental real estate is that it is a passive activity. That's default. So any real estate that you own is automatically passive. Doesn't matter, at least starting on stage one here, it is a passive activity. Now there are exceptions to the passive activity rules, and there's two exceptions. The first, if you earn less than $150,000, you can claim a passive activity loss allowance up to $25,000 a year. The second exception is if you qualify as a real estate professional and materially participate in your rental real estate activity. Now, why would I want to have an exception to the passive activity rules? Well, when I invest in real estate, so I buy $1 million property, it's an apartment complex, I do a cost segregation study, I'm probably going to be able to claim $250,000 to $300,000 in first year bonus depreciation. And that's because this cost seg study allocates $250,000 to $300K of value to 5, 7, and 15-year property. And because of the 2017 Tax Cuts and Jobs Act, I get to claim 100% bonus depreciation on any component with a useful life of less than 20 years. So big write-off, right? If I'm going to claim $250,000 in depreciation, I'm probably going to end up with a $230,000 loss. Now, the question is that a passive loss or is that a non-passive loss? And if it's a passive loss, I might not be too happy, because a passive loss can only offset passive income or gain on the sale of passive activities. So if I can sell another rental property, or I can liquidate a stake in a syndication, and I can have passive losses offset that gain. But if I don't have that and I don't have passive income, then I'm stuck with $230K of losses, and they're just going to be suspended and they're going to be carried forward indefinitely. So the question is, well, how do I maximize it then? I want to be able to use that loss And that's where we look to those exceptions. And specifically, we would be looking at that real estate professional exception. So qualifying as a real estate professional, materially participating in the rental real estate activity, what it does is it changes the classification from passive to non-passive. And now my non-passive losses can offset all of my income. Doesn't matter if I have W-2, business, dividends, capital gains, selling Uber stock, whatever you want to do, your passive losses can offset that income at least through the end of 2020. And there's going to be a cap on that going forward in 2021, which we can get into later if we want to. But
and I hope people on the call heard that, because that's really the meat and potatoes of it, right? It's really, you have, just to kind of simplify it, and Brian, correct me if I may say anything wrong, but really you have two buckets of income, right? You have your active, you have your passive. And your passive losses can be, held up against your passive gains. That's fine and dandy, but most people, unfortunately, I would say a lot of people have, their income's actually in the active section, right? Your passive is your distributions from stocks, maybe some income from your other rentals, but the active is your W-2 income. And so, most people have, maybe you're making, $100,000 salary in the active side, but you can't, basically use that to offset the loss of the passive side. And so it's a matter of how do you become an active investor. And, maybe Brandon, I'm going to cue you up for that question, and then one other, and then we'll maybe start going through people's question, because the other really caveat that I'd like you to kind of go into, and this is something I recently learned, which I thought was huge, but with the new, basically with the current, the stimulus that kind of got passed, right? Now you can, instead of just carrying your losses forward, right, you actually can carry them back. And on top of that, right, even if you weren't an active investor, an active real estate investor a year ago, but this year you are, you can actually apply that to go backwards, right, Brandon?
Yeah, exactly. So if in the current year you qualify as a real estate professional for tax purposes and you materially participate in your rental real estate activity and you have really large losses this year that have been created this year, and those losses exceed all of your other income, then you do have a net operating loss, most likely, that you can carry back 5 years. Yeah. So we've been helping a few of our clients with that. And one of the strategies to kind of maximize that, by the way, is to look at all of your acquisitions that you've made over the past 3 years. So, I mean, we're going all the way back to 2017 when we're trying to create these NOLs for 2020, right? So we're looking at 2017, 18, and 19 acquisitions, and we're asking, hey, can we qualify as a real estate professional in 2020? And if we can we cost segregate all of the acquisitions that we've made previously that maybe we didn't cost segregate because maybe we couldn't qualify as a real estate professional? So now we can cost segregate. We can file a Form 3115 and a 481A adjustment. When we file those forms, we get to claim all the 100% bonus depreciation, or 50% if you bought early 2017. So we get to still claim all this bonus depreciation in this year. We get to pinpoint everything in 2020. If we can crush everything in 2020 and create this big loss, that is a non-passive loss, then yeah, we can carry that NOL back 5 years.
Which is huge. So for people that have active income, right? Maybe you had a W-2 job for 4 years and then you quit and you became a full-time real estate investor, right? It's powerful. Now you can go back and capture all your losses against that past 5 years of income. So that's a little thing that I think a lot of people don't know about. But to me, that was a huge kind of thing. Yeah. But I think maybe the natural question that people want to ask is, what qualifies as a real estate investor? And that'll be my last one, then I'll shut up and then we'll just start reading the questions that people have.
Yeah. So what qualifies as a real estate professional for tax purposes? So the first important thing here to understand is that all that matters is the time that you spend in a real property trader business. It's all that matters. Doesn't matter if you're a real estate agent, doesn't matter if you're flipping, if you're if you're a landlord, doesn't matter. All that matters is the number of hours that you spend. You have to spend 750 hours and more than half your time in a real property trader business. So let's talk about who is not going to be a real estate professional for tax purposes. You will not be a real estate professional if you work a full-time job. If you have a W-2 job that is full-time, it's just not going to happen. We have clients every once in a while that go, no. I definitely work more in real estate than I do at my 2,000 hour a year job, which I find hard to believe. And we won't take that position because there have been about 100 tax court cases where people have tried and every single person has lost. The people that have full-time jobs that do qualify as a real estate professional are going to be pilots, like airplane pilots, boat pilots. They have full-time jobs, but they're not actually working full-time. Anybody in an industry where you get paid a full-time wage, you're technically a full-time employee, but you don't actually work full-time. Teachers can potentially count. There have been court cases in the past where teachers have won and lost. So you just have to be really careful about the time that you log in, and that's really the key there. But yeah, we're just looking at 750 hours and greater than half our time in a real property trader business. Real property trader business is going to be construction, wholesale, brokering, acquisitions, liquidations, rental management. I mean, anything that you can think of that's like real estate specific is going to count. I cannot qualify as a real estate professional because I am providing tax services to real estate investors, right? I'm not working on the real property trader business itself. Attorneys won't qualify, insurance agents won't qualify, mortgage brokers, private money lenders, none of those people are going to qualify, right? So it's really important to understand who does qualify, and it's typically going to be the people that are actually, like, I almost think of it as people that are actually walking down to the property and touching it or making it go. They're operating it, or they play a hand in that, right? They're either building the asset so that it can be operated, they're selling the asset so that it can be operated, or they're running the asset itself. Those are the people that are going to qualify as a real property trader, as a real estate professional. But it's also important to understand that qualifying as a real estate professional in and of itself does absolutely nothing for you. The second piece to all of this is that you have to materially participate in your rental real estate activity. And this is critically important. And it's even more important if you are not a landlord, if being a landlord is not driving the primary, if that's not the primary activity for you, then this is super important to understand. So all the time we'll get builders, developers, real estate agents who go, well, I do real estate full time. I am automatically a real estate professional. And we go, yes, you are. You are automatically a real estate professional. You have met that threshold, but we're still not going to claim your losses as non-passive because you've not demonstrated that you've materially participated in your rental real estate activities, right? So if you're a landlord full time and you qualify as a real estate professional on your landlord activities, then you've got the material participation piece in the bag. Material participation, the safe harbor for it's 500 hours in a rental property trader business. So if you've hit 750 in that landlord business, then you're good because you've already hit the material participation piece. But where we often see the issues are when we have a person that full time is a real estate agent and they go, well, I'm a real estate professional. Why can't I take my losses? Because you didn't demonstrate that you materially participated in your rental real estate activities. That's step number 2. Step number 1 is just real estate professional status. So that's really important to understand. It's also important to understand that you can combine your spouse's hours for material participation purposes only. So if you are a real estate agent, if you are developing, if you are in construction, if you are wholesaling and you qualify as a real estate professional on those activities and your spouse is managing the rental real estate, then you can qualify. You're good. Right? Because the spouse is going to materially participate in the rental real estate activities, and together you can combine your hours for material participation, not for real estate professional, but for material participation. It's good for people that have W-2 jobs, right? Oftentimes we'll have a spouse that will be a real estate agent, and then we'll have another spouse that has a W-2 job and manages the rental real estate. Well, maybe the spouse that's the real estate agent doesn't want to touch the rental real estate. That's fine. Just let them be a real estate agent. They'll qualify as a real estate professional for tax purposes. And then you can just manage the rentals. You materially participate, and now you guys can combine hours for material participation purposes, and the losses will be non-passive.
Can you just do that again? Because I've never heard that. So you're saying that.
Al's got a wife, and he's trying to figure this out.
I was like, hey, I got a spouse. No. So yeah, could you say that again, Brandon?
Yeah. What part?
So it's just with the spouse, because I think there's a lot of people here that are investing in real estate. They maybe have a couple properties, but they also maybe have a W-2 job or they have a full-time job, right? But now, how would they, or is it possible, like you said, to have their wife, either qualify as a real estate professional, or could they share the, the material time duties?
Yeah. So we have a couple of things that we can do with spousal relationships. and a couple ways that we can structure this. So let's say one spouse A, is earning $300,000 in their W-2 job, and they're just doing their W-2 job that's full-time, and they don't have a lot of time to touch rental real estate, but they want to use the losses to offset their W-2 income. Well, spouse B can go and be a real estate professional and materially participate in the rental real estate portfolio, and the losses will become non-passive, and they'll be able to basically say, well, because of spouse B's status in real estate, the losses are non-passive. Now we can offset spouse A. We can offset their W-2 income. So that's one option. That's the most common option. But the second option is spouse A is the W-2 earner, $300K full-time. Spouse B is a real estate agent. And maybe spouse A is the more financially savvy one. They want to manage the rentals. Spouse B does not. So spouse B, as a real estate agent, will qualify as a real estate professional under Section 469 if they're doing it full-time or even part-time. They'll qualify. So you get hurdle number one out of the way. So one spouse has to qualify for a real estate professional on their own with their own hours. And spouse B does that by being a real estate agent. But material participation in the rental real estate activities is lacking in this example. So you could have a massive portfolio that generates millions of dollars in losses, but if spouse A is qualifying as a real estate professional on the agent activities, and spouse A over here is just doing the W-2 job, and neither one of them are materially participating in their rentals, then they can't claim the losses. The losses are still passive. But spouse A, being the more financially savvy one or whatever, maybe just has the bigger interest in rental real estate, spouse A can spend 500 hours or 100 hours and more than anyone else, and they will rise to the level of material participation. And because spouse B has already hit the real estate agent, or already hit that real estate professional threshold with the agent activities, even though they contribute 0 time to the rentals, they can combine hours for material participation purposes. So spouse A can hit material participation. Spouse B doesn't have to worry about it. They'll just hit real estate professional.
Good question. So if let's say you're invested in a syndication, right? The same example, 10 million, a ton of money in a syndication, right? Where it's passive. But you go buy one rental house and you manage that yourself. Does that now qualify you to be in the active? And now really all that you have invested in the syndication can also apply?
Potentially. It depends on your activities in the syndication. It also depends on
if you're purely a passive investor in syndication,
like a limited
yeah, I'm an active real estate investor in a house, right? Like the wife example, they were managing, maybe one person's W-2 income earner, the other person's managing that one property, right? They bought that property specifically so they can, bring this bucket over here, right? Does that? Yeah. They don't care about ratio. It's just purely you have something that you qualify in terms of the time, and you are managing a piece of real estate.
Yeah. So again, though, it depends on your stake in the syndicate, what type of membership units you own. If you own limited partner membership units, then you cannot ever count the hours in the syndication. Doesn't matter what time you spend. If you own GP membership units, general partner membership units, then you might be able to count some of those hours because you can influence decision-making and because you have a vote theoretically. So that's one piece of it, right? But the other piece, let's say that you are a limited partner in the syndicates. You can't count any time at all from the syndicate activities. Yeah. The other piece is you can qualify as a real estate professional on your own rental portfolio. And then you can make what we call the 9 election. It's an aggregation election. And you can aggregate in all of your rental real estate activities into one activity. And if you're aggregating in everything into the activity that you already qualify as a real estate professional on, you already materially participate in, and then you're just aggregating in these LP interests, then yeah, you can use that strategy. And a lot of our clients will do exactly that. And then it's really nice. It's really flexible because at the end of the year, we can look at their tax return and say, hey, we need to generate $100,000 loss. They'll go put $100,000 into a syndicate as an LP. And then boom, we get the loss because the syndicate's going to run the caustic study. They're going to pass the 100% bonus depreciation back to the LP. So yeah, you can absolutely do it. Can you do it on one property? That depends on what type of property, right? There's a court case that dropped March 2018 that says you can do it on one property. It's that during the same week, there's another court case that says that you can't do it on 10. So it just kind of depends on the activities that you that you're doing with the property. And the one that did qualify, it was a big rehab project, and it took a long time, and he was doing it all himself. The 10 properties that didn't qualify, the woman actually, the court basically said, we believe you could have been a real estate professional, but your time log says that you're at the rental property on a Saturday. And when we subpoenaed your credit card statements show you traveling in London. So which is it, right? So it's those types of things you have to watch out for. But yeah, you can definitely do it with one property.
Awesome. So I guess I'll start going through questions then, just to kind of, let people chime in as well, things that they wanted to know. So maybe a simple one, but do you assist with cost segregation studies? I think you do not, right? You just kind of help with, someone else does the cost seg study, you're just taking that and, applying it.
Yeah, so we're not going to do the cost segregation study for you. Now, there are software cost segregation studies that can be performed. KBKG and ELB are two companies that will do that. They have a software program that you can use, and it's essentially for properties that are less than $1 million. So for the longest time, less than $1 million, it has not been feasible to run cost seg studies. These two cost segregation companies basically pooled or aggregated their decades worth of cost segregation data, put it into an algorithm, and I guess I should say a statistical analysis. And they basically say, hey, if you give these certain inputs, we're 95% confident that this is 100% correct, and buy our audit insurance on top of this, or I believe KBKG includes it, and we'll do the cost seg study for you for free if it ever gets contested during an audit. And those cost $500. So when our clients are doing one of those, yeah, we'll help walk them through it. Typically, we'll hold their hand through that process. But other than that, we're kind of just coordinating with the cost seg firm on the larger properties, just making sure that, when we get a report back, that it makes sense and that it's thick enough to meet our criteria.
Gotcha. All right. Next question. If a syndicate buys my building, can they write off all the improvements in 1 year?
If a syndicate buys your building, can they write off all the improvements?
Yeah, that's the question. So write off all the improvements in year one. The part that's confusing me is the syndicate buys my building, but I think let's just reposition the question, right? And Martin, I think you asked this question. If I'm not repeating it correctly and you're asking something else, let us know. But I think what the question is if an asset gets bought and they put $1 million of rehab into it year one, can that $1 million of improvements get written off in year one?
Yes and no. So some of it can probably get written off in year one. What we'd be doing is we'd be applying the 2013 tangible property regs first to try to figure out any sort of safe harbor application, betterment, adaptation, restoration test, that materiality threshold, to see if we can actually deduct anything as a repair. But then we would be moving into capitalization territory and trying to bucket it between 5, 7, and 15-year property or 27.5-year property. And if we can assign a 5, 7, or 15-year life, then you can write it off in year one via 100% bonus depreciation. So yes, you can write off improvements in year one, either as repair or via 100% bonus depreciation. Can you write off the entire amount? No, probably not.
All right, next question. Do you often work with low-income housing properties and the applicable tax credits?
We do. I'm not the expert in my firm on that topic, but we do have a woman that's very good at it.
All right, next question from our friend Chris. For the passive investor, can you talk about investing using an LLC, corp, or other entity versus investing in their personal name? Any tax benefits one way or the other?
So 99 times out of 100, there are no tax benefits between an LLC and corporation. In most cases, the corporation is actually going to hurt you, whether it's an S corporation or a C corporation. That 1 out of 100, if you're earning $1 million plus, then a C corporation could potentially provide you with some sheltering. We actually call it a C corp blocker because the C corporation prepares its own tax return and the income does not flow through to you. It's blocked. So potentially could be beneficial, generally not. And if it's generally not beneficial, there's really no difference between personal name versus LLC. we're going to recommend LLC for those 99 times out of 100 because it does keep it super flexible. LLCs are very flexible and you get that liability protection.
Next question. I've heard of conflicting reports on
Could I just add that, just with that question, is there any difference between doing with an LLC, like if a passive investor invests passively through LLC versus their own personal name?
Not from a tax perspective.
Okay.
Yeah, you might want, I mean, you might have local franchise taxes. Like if you set up an LLC in California, you've got an $800 tax every year. Maryland's 300. You know, you've got all these different states and localities you have to watch out for when you set up LLCs. So it might increase your administrative burden, but from a tax perspective, you're not going to gain anything by using an LLC. That said, there is definitely a liability aspect to it. And the way that I think about it is if something happens in my personal life, and I'm not an attorney, so take my words with a grain of salt here, but if something happens in my personal life, if I don't have that LLC, well, the syndicate's making distributions to me personally right now. That can all get wrapped up in the lawsuit. But if I have the LLC and the LLC has a bank account, the syndicate makes the distributions to the LLC. It sits in the LLC's bank account. I don't technically have to distribute the income to myself. So it could provide a little bit of benefit there in terms of asset protection.
All right. So then, Chris, I'm going to skip your next questions. I think we covered it, unless you say otherwise. All right. Next question is, can you provide some info on opportunity zones?
Yes.
For those listening, maybe a quick rehash of what an opportunity zone is and why it's a interesting tax vehicle.
Yeah, so opportunity zones were enacted back with 2017 Tax Cuts and Jobs Act. Relatively flew under the radar for a while until people really picked it up. But basically, if you invest in a qualified opportunity fund, you can roll your capital gains over into the qualified opportunity fund. Section 1250 recapture, depreciation recapture can also be rolled in. And I believe if you hold, I'm not the qualified opportunity fund expert on my team, so I'm going to apologize for potentially messing this up in advance. But if you hold for, I think 5 years, 5 years? Yeah, 5 years, you get a 10% step up in your basis. So if I roll over 100K of capital gains and I hold for 5 years, my basis is 0 in the capital gains. But if I hold for 5 years, I get to jump it to 10,000. So I've sheltered 10K of my 100K capital gains. If I hold for an additional 2 years, then it's it's 15% total. So now my basis is 15K. I've sheltered 15K out of my 100K. But in 2026, everybody has to pay tax on the capital gains that they've deferred. So if you invest today, you're not going to have 7 years elapse. So you're only going to be eligible for that 5-year step up at this point. So you're going to lose out on that additional 5%, which may or may not break an investment for you. But also, if you hold for 10 years, a total of 10 years, whatever gain that you've invested, the additional gain that you've made, the additional appreciation on the original investment will be tax-free. So there are tax benefits. Our clients have not been very interested in opportunity. Everybody was really interested at the beginning. We were putting out all sorts of content at the beginning. But what we realized is a lot of our clients really aren't interested in opportunity funds because of that 10-year hold period. A lot of our clients like to have a little bit more flexibility.
Next question, can you talk about any slick moves that clients have done, some success stories or aha moments?
Yeah.
Good question. I like that, Chris.
Yeah, I mean, there's real estate professionals, obviously a big one. I think that another thing that a lot of people don't realize, and a lot of CPAs and tax advisors don't know, is that your short-term rentals, I don't know if you guys invest in short-term rentals, but if you do invest in short-term rentals, or if you want to invest in short-term rentals are excluded from the definition of a rental activity under Section 469 of the tax code. And remember, Section 469 was everything we just talked about. So that's the code section that says rental activities are default passive. You can get around that by qualifying as a real estate professional, yada, yada, yada. So if a short-term rental falls outside of that section, then what that means is that you don't have to qualify as a real estate professional in order to take the losses as non-passive. You just have to materially participate in the rental activity. So if you have a short-term rental, you could theoretically have a W-2 job. Your spouse could have a W-2 job. Everybody could have a W-2 job. and you could just materially participate in the short-term rental. The losses that you are able to generate on that short-term rental via cost segregation ideally would be considered non-passive. So you don't have to worry about real estate professional status at all. It's a much lower bar. And that's something that we see CPAs get wrong all the time, especially if the landlord has other long-term rentals. They'll show them all on Schedule E, and they'll just throw in the losses as passive from the short-term rental without really giving it any sort of consideration. So it's a good planning opportunity to kind of go back and correct. But for you guys, and I know this is a multifamily group, but realistically, short-term rentals are going to provide a great opportunity come Q3, Q4 this year. And if you can get into one of these properties and effectively get your down payment back after you run a cost segregation study because of the non-passive losses and the tax refund that comes as a result of that, could be a decent opportunity to acquire some short-term rentals.
Oh, I did not know that. That's very interesting. Yeah, but there's still recapture, right? That doesn't change, right? Okay.
Yeah, still recapture.
Sure, I didn't find another loophole. All right, let's keep going then. So what are some of the biggest misconceptions you get from investors, assumptions they come in with that are incorrect?
There's a lot of incorrect assumptions. The most frequent ones are revolving around real estate professional status. Well, I got my real estate license, so I'm going to be a real estate professional. It doesn't really work like that. It's about the hours that you spend, right? You have to spend the correct amount of hours. My most favorite incorrect assumption is when we have clients that are in real estate full-time. So they are a syndicator full-time. They are investing in rental real estate full-time. They are building or being an agent full-time, and they refuse to keep a time log of their activities. What we have done to combat that is I just put my foot down and said, well, we're not going to claim real estate professional on the tax return unless we get a time log. And we're not doing it to be a pain in the butt. What we're doing is we're saying, look, there are court cases, and I have a whole list of them. There's at least 15 that these people are full-time. They're full-time agents. They're full-time builders. They're full-time landlords. They don't have a time log in the court case. The courts shoot them down. They say, sorry, you don't have proof. It sounds ridiculous, but those are the ones that kind of fire me up, because it's like, look, you're hiring me. I'm not going to give you the advice that you want to hear. I'm going to give you the advice that you need to hear, because when we get under audit, I want you to win, right? And you're not going to win if you have to go back and recreate your time log. Like I was talking about that one tax court case from March 2018. The woman had 10 properties. Her time log says she's working on a rental on Saturday, but her credit card statement says she's in London traveling. Well, what do you think happened? She got audited and she retroactively built her time log out. And we just don't want our clients to fall into that. So that's a big incorrect assumption that we see more often than we'd like to.
All right. Let's see. Next question. Do you ever utilize TIC structures and or DSTs to assist syndications to take advantage of 1031?
Yeah, definitely. There's drop and swaps. There's, I guess that's not really technically a drop and swap, but yeah, we use TICs often. We've helped people through relatively complex 1031 exchanges. You have to be really careful. The advisors that you work with, we had an attorney at one point that was like telling our client that, we don't know what we're talking about, and we're way too conservative. And he was recommending this structure, and we were like, it's black and white. It's like literally written in the code right here that you can't do that. And we ended up getting I ended up paying 2 national law firms to tell me if I was right or wrong. We were right. So you just make sure that you're working with, and this attorney had 30 years of experience and way more than we had. That's why we were like, wait, are we wrong? But yeah, we've worked with a lot of complex structures, and it's good to, especially if you're investing in syndications, it's really good to ask that question up front when you're before you make that investment. What sort of tax mitigation strategies are you going to be employing here? You're going to cost seg, you're going to bonus depreciate, are you going to elect out of business interest limitations? And by the way, at the end, is there any sort of 1031 opportunity? Are you going to 1031? Do I need to drop out of this syndicate so that I can 1031? There's a lot of good questions that you can ask up front, and so that you can start putting your plan in place way before you actually need to.
All right. Next question. Active investor in the syndication. If there's 4 to 5 partners in a syndication, are they all active or are there thresholds?
Yeah, so this goes back to that material participation thing for us that I think you were actually asking me about, and it depends. It depends on 2 things. It depends on what type of membership units you own. If you own LP units, limited partner units, you're not going to ever qualify. Your hours will not count. You're just an investor. If you own GP units, your hours can count, but it doesn't mean that all your hours are going to count. You actually have to be working in or on the syndicate, moving the property forward, helping with operations, making decisions. If you're just reviewing, monthly or quarterly financial reports, even if you have a GP stake, that would be an investor level activity and those hours will not qualify.
All right. Next question is, I understand the hurdle for becoming an active investor while having a W-2 is proving you work more on real estate than your W-2. What are the best ways to prove this?
If you work a full-time W-2 job, you will not be able to prove it. You just will not. You can try, and you're going to join the rank of the 100+ people that have already tried and lost in court. It's just not going to, it's never going to work. And that's actually going back up to the incorrect assumption. I actually have a big presentation on real estate professional, all sorts of fun citations. And one of the slides at the end is the mistakes that investors make and the mistakes that advisors make. But one of the mistakes that investors make is thinking that they can qualify as a real estate professional when they have a full-time W-2 job. It's never going to happen. If you have a part-time W-2 job, you can qualify. Or if you are a boat pilot, or you're an airline pilot, or you're running some sort of other job where you're not actually working full-time, you can potentially qualify. But just understand that the tax court is going to subpoena your employer's employment records. And they're going to look at that pay stub. And if it says 40 hours, they're going to use that. They're going to say it's 40 hours. 40 hours a week. That's what you're being paid to do. So it doesn't matter what you say. This is what's being recorded by your employer. This is what you're getting paid to do. So now you have to overcome the hurdle of 40 hours a week on the rental real estate side of things. And that's an additional 2,001 hours for the year. So you're working 4,001 hours for the entire year, which is a lot of time.
All right. Do private money lenders qualify as real estate professionals if there is no other W-2 income?
No. Private money lenders are not going to qualify as a real estate professional. There's a tax court case that came out in 2017. It's Hickman TC Summary 2017-66. And that one specifically says mortgage brokers. I should take it back. It depends on the facts and circumstances of your private money lending activities. You may be able to qualify depending on exactly what you're doing. But if you're just putting deals together and lending funds, then typically no.
Next question. Finally, an actual advantage to logging most of my 830 plus hours year to date being a landlord and doing hands-on rehab. Kudos to you, Eric.
There you go.
All right. From Eddie, can I qualify for real estate professional if I work a normal job outside the country, but I deal with lots of real estate investments?
If your normal job is 40 hours a week, I'm going to say no.
All right. Next question. Do we have to cost seg on the smaller properties? For example, $100,000 single family rentals. Yes, I think to get benefits of cost seg, you do. But the thing I did learn is that there are cheaper ways to do it than, like what we do on large apartments, right? I did not know that existed whenever I did my rentals.
Yeah. You don't have to do a cost seg. You actually don't have to do a cost seg ever. The cost seg firms and CPAs that want you to do cost seg all the time will tell you that's the technically correct way to do it because they're trying to push services on you, but you don't need to cost seg anything. You can just depreciate everything straight line over 27.5 years. Can you cost seg less than 100K? Sure. Yeah, you can do it.
All right. Next question. I think the questions keep on growing, so I guess that's good. And we'll cut it off in 10 minutes, and then we can kind of do 10-minute breakouts and wrap up. So, I definitely appreciate you taking the time, Brandon. We're very appreciative of that.
Yeah, it's been fun.
All right, if I buy a very old building, is there any cost segregation, what they mean, still available even if it's a very old building?
Yeah, so when you buy any building, you get the new basis at your acquisition price, and you get to cost segregate that basis. So the building could be 1,000 years old and just stone, I guess, because that's how old That's what that building would be made of. And you could cost seg the 1,000-year-old building. So it doesn't really matter how old the building is. You can cost seg it. Now, will certain buildings and certain ages provide different results? Yeah, absolutely. But you can still do it. Mm-hmm.
All right. So let's go into a little bit of a lightning round mode, right? Just trying to see if we can kind of maybe bang out the best that's kind of help get everyone's answered. So,
okay, I'll try to speed my answers up.
Oh, no, your answers are doing great. It's probably me reading as well. So, all right. So this one, to summarize it, basically, if you have a couple, one's a high W-2 job earner, another one is a low W-2 job on a part-time basis, and they've met the 750 hour requirement combined, can this couple claim to be a real estate professional status and offset passive income?
Yes. Yeah. So if spouse B, who has the low W-2 income because it's part-time and spouse B meets the hour requirements, but for real estate professional, but spouse A does the material participation, yeah, you can combine hours for material participation. So you can use real estate professional status in that example.
If one spouse does 100 hours and the other one does 650, does that count?
No.
It's not combined.
No,
Okay.
because one spouse has to achieve real estate professional on their own. Only for material participation purposes can you combine hours.
Got it. All right. Next question. Can you talk about the taxes incurred when investing in syndication as an LP using a self-directed IRA? So is it not recommended to do so?
Yeah. So when you invest in a self-directed IRA, when you invest in a retirement account, what you have to be careful about is UBIT tax exposure. Now, self-directed IRAs are subject to UBIT and UDFI. Solo 401ks are not subject to UBIT, but they are subject to UDFI, which makes them subject to UBIT on leveraged investments, which is often where people get confused. So self-directed IRAs, if you are investing with a self-directed IRA, you could have some UBIT exposure thanks to the UDFI component. Typically, rental real estate is not going to be subject to UBIT. That's unrelated business taxable income. It's not going to be subject to that. But the UDFI, the unrelated debt finance income, because of the leveraged investment, what it does is it triggers UBIT income. So a self-directed IRA could pay UBIT tax, just like a solo 401k could pay UBIT tax. In most cases, the taxes are relatively minimal. And I think that from an effective rate perspective, it typically comes out maybe a little bit about the same as if you were investing on your own. So,
all right. Next question. If you were to invest in a limited partnership and they purchased homes in an opportunity zone and not in an opportunity zone, so I guess they purchased homes in both, some opportunity zone and some not, can they use the tax benefits from the homes in the opportunity zone, or do they all fall into the same category of no benefits?
Well, so the fund that you invest in has to be a qualified opportunity fund. So anybody can go invest in qualified opportunity zones, but it doesn't mean that their investment's going to qualify for any sort of tax benefits. They have to set up a qualified opportunity fund, which is a little bit of a different process, a little bit of a different capital raising process. So I hope that answers the question. So maybe, but it depends on if they're a qualified opportunity fund.
All right, next question. Do you advise new construction developers? And if so, in what ways has your firm been strategically beneficial for such developers?
Yeah, I mean, we have developers and builders and flippers that we advise all the time. A lot of times with developers, flippers, and builders, it's more about entity structuring and the timing of recognizing receipt of income and the timing of expenditures. That's where we're going to kind of game the tax code a little bit. And more so the services that we're typically, the core services that we provide those folks are going to be the accounting services, making sure that we're on budget for our projects, giving you KPIs and financial information you need to make decisions and move things along.
All right, next question. Where do you advise logging time towards real estate tasks? Yeah,
good question. So you can do it however you want. You can use a Google Calendar, you can use T-Sheets, you can use Toggle, T-O-G-G-L, you can use a handwritten notepad. Most of our clients use Google Sheets because it's an Excel spreadsheet. Everybody knows how. Most people actually ran into a person the other day that said that they've never used Excel. And he was like mid-60s. I was like, that is incredible. That is honestly, I don't know how it's incredible. So, but most people know how to use Excel. So use Google Sheets because Google Sheets is an iPhone app as well. you can just do it on the fly. That's what most of our clients do.
All right. And as a former Microsoft employee, I also got to give a shout out. Office Station also has an Excel online version that can be an app as well. So.
Okay. Sorry. Yeah. Well, let's not forget the Microsoft team.
No, I'm just messing around. All right. Next question from Carrie. What about deferred sales trust for deferring capital gains?
Yeah, deferred sales trust is a great way to defer capital gains. I like deferred sales trust from the flexibility perspective. Like if I were ever to sell my CPA firm, for example, my basis is $0. So whatever I sell it for is also my capital gain. I might look into using deferred sales trust to spread that capital gain out. You can do the same thing with stock, RSUs, anything like that. You can also do it with syndicates. The gain has to be big enough, though. I mean, you need probably a minimum $300,000 gain to substantiate the cost of structuring one of these things and running one of these things. But yeah, I mean, you can do it, and it's a nice vehicle. It's a nice option to have, and it's one of our exit strategies that we talk about with on our content with our clients.
Nice. All right, next one's shout out. Basically, Palvin made a post. Basically, there's a link in the chat to get Brandon's ultimate guide to tax planning. So definitely, if anyone's interested, or everyone should be interested. Go ahead and go grab it, please.
Yeah, just so you guys know about it, it's like it's over 37 pages basically, where Brandon talks about like all kinds of things. Like I'm just looking at the table of contents right now, and it's like not only is it like how real estate income is taxed, but it's like short-term versus long-term rentals, cost segregation, 100% bonus depreciation and why that matters. Can you deduct the losses on your rentals that you create? All kinds of different things. So there's probably like 20 different topics in here. So it's a huge guide. Definitely appreciate Brandon putting this together and offering this to our audience and everything.
No problem.
All right. So I guess that's a wrap. So thank you very much, Brandon. That was valuable. I learned definitely many things. I'm sure everyone else in the call got some value from that. So really appreciate it. Hopefully, Brandon, you can stick around. We're going to basically just split up into random groups, and someone's going to get the special luxury of being in the random group with you and maybe pepper you with some questions or get to know you one-on-one, right?
Start my clock.
Yeah, all right. So we'll do that for like 10 minutes and then, wrap it up, right? Anything else to add, pal?
Nope. We're going to be into the breakout rooms, and then are we planning on coming back here first, or we're going to, is that the plan? Or
we can come back for just the same thing. So yeah, sure. We can wrap it up.
Well, if I don't,
we don't have to if we don't want.
Yeah,
I don't know how it works, but if I don't see you guys, like as we come back, thank you so much for having me. I really appreciate it. And also thank you for not asking PPP and EIDL questions.
I've heard of CPAs. That's all they've been living and breathing lately on that.
Oh yeah. It's been awful. Yeah.
All right. Well, no, thank you very much, Brandon. Definitely appreciate it. We'll post a link to your company website as well with the recording.
Thanks.
Really appreciate it.
Okay. Awesome. I'm about to send everybody to a room here. So I'll be going.
Powell, I feel like you're the wizard behind the curtain or something.
I know. I feel like I got like 2 computers here. Like I never work on like 2 computers. Like get all this like 2 computers. I got like Facebook up here and I got Slack going on there. Uh, nuts. So let me see. I'm just going to kind of close it out and everything here. I think everybody's probably back here. We just wanted to again thank Brandon for his time and everything, and his education and all the great bits of knowledge that he gave us. We'd certainly, in the future, Brandon, we'd love to have you come back and we can talk about any particular topic that you felt like talking about as well. Again, we do this every 2 weeks, so we're looking forward to have everybody back in 2 weeks. I think our plan is to have go over financing and the changes, rules that we've seen in multifamily financing. If you want to, people will share their emails and things like that inside the chat. You can also reach out to me if you want to get the Brandon's ultimate guide to tax planning. I have that available too as well, and I'll put that link here. That's not the right link. It's a different link. Okay, so just reach out to me, Powell at Multifamily Masters. Happy to get that to you as well. Okay. Other than that, I think we're great, everybody. Thanks for joining.
Thank you very much, Brandon. And like Paul said, next one will be Anton Matley with Peak Financing, talking through debt questions. So come with your debt questions. Just like you guys brought all the hard CPA questions, let's talk about debt next time.
Awesome. Thanks everybody.
All right. Thank you.